Welcome back, Econ Studs. Been a long time. We're now fast forward up to chapter 29. Money. In this case, we are really concerned with fractional reserve banking and how that creates money. So the important thing from this chapter is start by making a T-chart. This T-chart is an accounting tool used by banks. On one side, we have assets. That's everything that the bank owns, that it's property, it's what it controls, the things that are in the positive side for it. On the other side is the liabilities. That's what it owes to others. In the T-chart, the assets and liabilities will be equal to each other. So, on the liability side, we have deposits. Anybody who deposits money into a bank, that doesn't belong to the bank, belongs to you, and so that is a liability for the bank. Let's say that the liabilities for, let's call this Dieter Bank, is equal to $100. On the reserve side then, the bank has to keep a set amount of money in its vault in case people come and say, I want my deposits back. And in this case, it's usually about 10%. So 10% of $100 is going to be reserves of $10. Now the bank makes money by making loans to people. And it wants to loan as much money out as possible to make as much money as possible. So it's going to loan out the rest of the money, in this case, $90. Now, the money trail does not end with that. As that money is lent out, people can use it to consume things. So when they consume things, they pay someone for their good. Let's say that someone buys a calculator with the money that they've got from the loan. And that then goes from the merchant into the bank. We'll call this one the Fowler Bank. Same setup with the T-chart. We have assets, we have liabilities. Now, the deposit into the Fowler Bank was $90. So to keep that in reserve, we have $9. 10% of that is $9, which means with regards to loans, they can lend out $81. So let's say that's lent out again. And this time the money is used to pay for legal services. And once it's been paid, we deposit it into a bank. Let's call this one the Ekman Bank. Again, we have a nice T-chart. We have assets. And we have liabilities. And the deposit again in this case was the last loan, $81. So if we keep 10% of that in reserve, this would take us to $8.10. Amount of loans going out is going to be $72.90. And this process will go on again and again and again and again. And we see here how much money has been created. Let's say that we had that original $100, and then we had $90 more created, and then $81 created, and then we're going to loan out $72.90 more. We add all these up, the money this keeps getting bigger and bigger and bigger, and that's how money is created in our society. Let's say a central bank, in this case Federal Reserve, is going to deposit $100 into Dieter Bank. By doing so, it's going to have a much bigger impact on the overall country because this fractional reserve banking will take that money, lend it out, deposit part of it, lend out more of it, deposit it again and again and again. But will it go on indefinitely? No, because you notice here, this number keeps getting smaller. So the question is, how much money is created? And for that, we have a little tool at our dispense called the money multiplier. And the money multiplier is the reciprocal of the reserve requirement, which in our example, the amount of reserves the bank had to keep was 10%. 10%. So if I wrote 10% as a fraction, it would be 1 over 10. So the reciprocal of this is going to be 10 over 1, or just 10. So to figure out how much money is going to be created in our society, we multiply it by the money multiplier. So in this case, the Fed Reserve deposited $100 into the Dieter Bank. The reserve requirement is 10, so the amount of money created for our community here is going to be $1,000. And this one is a much shorter way of seeing how money is created instead of going step by step through the fractional reserve banking again and again and again. So that is fractional reserve banking. That's how it works. Questions here like how much money was created in this case? $1,000 was created. How much more in new deposits? We don't include the original deposit, so it's going to be $900 of additional deposits created. Only when money comes from the Federal Reserve is that counted as a new injection of cash. If this $90, is it new money? Yes, it's new money, but it's also already been out there because it is from this loan. Check out 29 more on that about the difference between money coming from the Fed versus money coming from stuff that already exists in society. We're going to practice more of that in class as well. So a couple final points. We have money. It has 3 uses. And what are those 3 uses of money? And it should fit all these. 1, medium of exchange. We use it to purchase things that we want. Down with the barter system. The second is that it's a store of value. It will not spoil with time. It should hold its value. And the third is a unit of account. People measure their income in dollars, not in hamburgers they can buy or cars they can buy. So it's a unit of account as well. And finally, last thing you want to know is the Federal Reserve is the institution that controls the money supply. And this is known as monetary policy. And they have 3 tools in which you control money supply. One is through open market operations. That is the buying and the selling of bonds to control the money supply. The second is the discount rate, which is the interest rate they charge banks to borrow from it. And the third one is the reserve requirement. The one that is used the most often is open market operations. I'll let you read chapter 29 to figure out why these 2 do not either change much or are used much. That's chapter 29. It's money. Check it out. When in doubt, graph it out.